In today's episode of the MSA Rental Market Update, we are looking at the Bloomington, Illinois rental market for conventional multifamily properties. You can see that we have the Bloomington, Illinois metro statistical area outlined here and where it is in relation to Chicago, Milwaukee, Des Moines, Iowa, Kansas City, Missouri, St. Louis, Louisville, Indianapolis, here Cincinnati, and Detroit is off the screen here a little bit, okay? So this gives you an idea where it is. Let's take a look at our filters, and as usual, we are excluding all corporate, military, senior, and vacation, and only including market and market affordable. So if we go to location, you can see that we are in market, metro statistical area, Bloomington, Illinois. So let's go take a look at the analytics and see what the analytics tell us for all three asset classes combined. So here is our supply side snapshot for the Bloomington, Illinois metro statistical area. There are 307 properties in this MSA, so a tertiary market. There are 11,219 total units. No units are currently under construction, and in the last 12 months, 135 more people have moved out than moved in, where the previous 12-month period, 122 more people rented than went vacant. We can see that the increase in vacancy from 2.5% to 3.7%. Woo! Woo! Look at that high vacancy. Yeah, okay. So this means we are probably still going to see some rent growth because there's no owner in their right mind that is going to start lowering their rents when vacancy is that low. And as we can see, we have a year-over-year rent growth of $947 to $978. As usual, we're not looking at the capital market. We are only looking at the space market. If we scroll down, we can see over the last 22 years, that long-term occupancy average, the market likes to be at about 91.25%, and it is currently sitting on 96.25%. That is the largest separation of market vacancy that we have seen, where the market is that much higher above that long-term occupancy average. So without looking at anything else, my guess is that when we get to the market cycle chart, this market's going to be fairly close to equilibrium. We do have that negative absorption, but we'll see what's going on when we get into the data. I have not seen the data. So right now, let's go take a look at the data, and we'll look at it for all three asset classes first, and then we'll do Class A, Class B, and then Class C. So here is the rent analytic data for all three asset classes. We are not looking at asking rent. We don't care what the owners want for rent. We only care what they actually get for rent. First quarter of 2022, we were at $951, went up to $982, and then down to $975. Even with that super low vacancy, we had a break in the rents, then back up to $982, and we're not going to look at Q1 third quarter, which would be the month of January, primarily because we've been seeing some erroneous data here. So we're just going to discount it for now. We're only going to look at the fourth quarter of 2022. So that said, we seem to have stabilized a little bit here, even though we're sitting at 3.3% vacancy. Very interesting. Let's see what delivery, well, there was no delivery, so let's see what absorption's telling us. So there was 2 units, or is 2 units currently under construction, and no deliveries. It does look like that duplex delivered in January, but again, we're not going to account for that yet. But we've got negative absorption happening from fourth quarter of 21 all the way through fourth quarter of 2022. And of course, CoStar is reporting that negative absorption is continuing into the Q1 of 2023. But again, we're not going to look at that data right now. But according to what the occupancy is telling us, we should see the absorption going in this direction because these owners should be working towards a stabilized vacancy. And even though this market's about 91.25 long term, owners like to see it around 93%. So they got a ways to go yet before they get there. So I do not blame the ownership for continuing to raise these rents. And this negative absorption, we're just trying to get to that stabilized vacancy number. So Let's take a look at each individual asset class and see what story that is telling us. We'll go look at Class A first. Here is our Class A rent analytic data, and much like yesterday, we only have one property in the market that totals 210 units. So not much we're going to be able to glean from this data. It does look like the Class A market went from 1422 in the first quarter to 1404, so down right away. And again, that's just this one property and how this property is performing. It is sitting at a higher vacancy than the market is. And you can see that from the third quarter to the fourth quarter, it went up in price. And when it went up in price, the vacancy also went up. So it looks like between this 1294 and this 1334 seems to be an apex. And then, of course, it's saying that it went down. But again, we're not going to take a look at that right now just because this could be erroneous data. That is a major decrease in rent. So it does look like that this apartment complex, maybe, I don't know where it's located, it could either be an affordability issue, or it could be its location, or maybe it just wasn't built to standard. We don't know that by looking at this data. So let's take a look and see what the absorption is on it. And as it should tell from going negative every single quarter, except that one quarter, there are people moving out of this apartment complex. More people are moving out than are moving in. And we are right at or close to that long-term occupancy average. But again, the owners like to be around that 93% point. So we're below that, especially sitting in a Class A property. So not much we can glean from this, but, you know, nice to see one single property in the market. Let's go take a look at Class Bs and see if we can't get a story from that one. Here is our Class B rent analytic data. That's a lot better. We have 84 properties in the market totaling 5,714 units. Looking at effective rent, which is well below that Class A, they started at 1019, went up to 1049, then down to 1042, and then up to 1052. So a little bit of waffling like we saw in the overall, even though, once again, that vacancy is very, very low, 3.5%. So let's look at our absorption, and we can see that we are negative in every single quarter. But again, until we get down to about that 93%, I think we're going to continue to see some rent growth here. So not a much different story for the Class B than we saw in the overall. Could be what's driving the overall. We already know that there's only one property in Class A, so we can't even determine that information. So let's go take a look at see what Class C says, but it looks like we're getting closer and closer to putting this market right on that equilibrium point, which could put the Bloomington, Illinois market as one of the top markets in the country. But let's see what Class C tells us first. Here is our Class C rent analytic data. There are 207 properties totaling 5,248 units. Looking at effective rent, we were at $802 in the first quarter, up to $836 in the second, stabilized at $836, stabilized at $836. Very interesting that these rents have stabilized like this, considering that that vacancy is at 2.9%. That is really interesting. I would have expected to see these rents continued on an upward growth trajectory and not sitting here at 2.9%. So let's take a look and see what absorption's telling us. First time we've seen some positive absorption in the market. And even with that positive absorption, it still was stabilized in those rents. So very interesting tale. I don't really know what's going on here. Maybe the ownership is just afraid to raise these rents, but with this low of vacancy, this high of occupancy in this market, they really should be trying to raise these rents a little bit more than this, or maybe that one Class A property is spooking them. But honestly, probably not a lot of owners even know what's going on with that property or even care because it does not compete with them. So that said, wow, Bloomington, let's take a look at our market cycle chart. And remember, we're 5% above that long-term occupancy average. We're seeing rent growth and some stabilized rents, a little waffling around with some negative absorption, but with the vacancy so low, with that long-term occupancy average being down at around 91 and a quarter, 91 and a third exactly. Until they get that occupancy down to about 93%, I'm pretty comfortable putting the Bloomington, Illinois metro statistical area right here on equilibrium. And honestly, I think we're hard-pressed not to call this one of the top markets that we have seen in the country so far, even though it's in Illinois, okay? And I know a lot of people don't like Illinois because of the political landscape that is in that state. But like other states, including California and New York, you do have markets that you can invest in. All right, this isn't Chicago. Speaking of Chicago, we will be looking at Chicago next week. So this concludes the Bloomington, Illinois metro statistical area for rental properties of conventional apartments. Stay tuned tomorrow as we are going to go take a look at Augusta, Georgia, just in time for the Masters, if you happen to be a golfer. So I will see you guys tomorrow.